Okay, in this video, we're going to talk about something referred to as pro forma analysis. Essentially, what pro forma analysis is a forecasting tool. We want to forecast future financial statements of the company. We want to then be able to address what the changes might be in the financial status of the company given some strategic moves that we may want to make with respect to operations. So the basics, the objective of this analysis again is to predict cash and other funding needs. So it can be used in conjunction with strategic plans to see, again, as I said, how actions might affect the financial ratios of the company. The concept is simple. We just predict future asset needs based on projected changes in sales. We then need to determine the funding available for any potential changes in asset base. And then, if necessary, we need to begin the process of funding any potential shortfalls. So we have to start with a projection of sales growth for the next year. We then need to look at the relationships of the line items in the financial statements. Some will vary directly, and some will not be impacted by sales at all. For instance, accounts receivable will surely change if sales change, but long-term debt is something outside of the operations of the company. It's a financing question, not an operations question. So the next step then would be to determine the assumptions of those line items, right? How are they related? Now, much of this could come from historical information about the company. If we had several years of financial statements, we could calculate the ratios, find averages, employ a little, in quotes, gut feel to those numbers to maybe make changes if we see fit. But in the end, the output of this whole process is going to identify a cash shortage or surplus. Then, of course, we have to figure out what to do with that situation. So the input, we need to input the data from the last income statement and balance sheet. Now, the templates that we're going to use are templates themselves, right? So that they can't be changed to reflect the specific nature of your company. So we may have to finesse the numbers a little bit to make them fit the template. The yellow boxes are data boxes, and all the other boxes should be password protected. So the first thing we need to do is to enter the most recent data here in these spreadsheets. So let me pull up real quick the pro forma analysis spreadsheet, stick it in the middle here, so you can see that where this information is coming from. Again, you see at the top here is the pro forma analysis spreadsheet. Right here is where we're working right now. We're inputting the financial statements from the most recent year of the company's life. Once that is input, then we need to start asking some questions about the data, right? What is the sales forecast? In this case, we're forecasting 15% growth. We have information here about expense items. These things, again, come from potentially historical data. One thing to keep in mind is this taxes as a percentage of EBT. We need to make sure you understand what that tax rate is there. Again, it's something you can calculate. It's not very difficult, but that does change from time to time for a company. We need to know the company's dividend payout ratio. So one of the assumptions we're going to make is that once we decide if the company needs money, where do they go to get it? the first assumption is we're going to assume that of their net income, some of that money is paid out as dividends and the remainder is kept in retained earnings. And of course, that money is reinvested. So internally generated capital is already incorporated into our financing question. So once we then go to the balance sheet input section, if you look at the first section here, you'll see we're going to assume depreciation's 10%. Let me clean this up a little bit. Is 10%, right? These other numbers, these all come from financial ratios, or we get them from the internet or whatever. At the bottom here, you notice it says, do you need to buy assets? Well, based on capacity, right? This company is working at 85% capacity, and they have a target fixed asset total ratio of 1.3. Their current fixed assets are 81,000, but based on these numbers, they actually need 104,000. So this thing says, yes, you need to buy some assets. So what you'll see is in the next page, in the next slide, when I change and put in here, I purchased $30,000. You see, this now changes to no, because now we have enough assets, right? 81 plus 30, that's 111,000. So now we have enough assets. What should you do if it says you're supposed to sell assets? Well, now we have to ask some questions. Why do we have too much? If we're in a recessionary period, maybe we don't want to get rid of assets. It may encourage us or give us some incentive to look at our assets and see if there's anything that's obsolete and not being used. Of course, those could be sold off if they're not being used. So now we have our first forecast, right? So here's the actual year's data for the income statement and retained earnings. And what you'll see here is what's referred to as the first approximation. As we go down this list, this just applies those formulas, and you'll see that we have 10,000 in net income. We started with 19,000 in retained earnings. We paid out some dividends, so we're left with 24,238, right? So this difference here, this $5,000 difference, is what goes to retained earnings as internally generated capital. But what you might notice here, though, is the interest expense doesn't change. It won't change until we find out if we need money or we have extra money. When you look at the balance sheet, again, we see the projected income balance sheet for next year. Again, the first thing to note is total assets is 129, total liabilities and equity is 109. They don't balance. The reason they don't balance is this is not a double journal entry system. This is a prediction model. What this tells us, though, is we need $129,000 to do the business that we expect to do next year. We need enough assets, this is our asset base, to perform those operations. But we don't have enough money to do that. So that means we need to go out and get $19,522 in order to do the business next year. If you note here, the capital structure looks at long-term debt, notes payable, and common equity weight. Now, this percentage of common equity is common stock because, as you remember, retained earnings already includes the increase in from retained earnings is already incorporated into our numbers. So again, here's our current capital structure, the amount of money we need. Now again, we need to make some decisions. How do we want to finance this $19,000? We want to do it 10% in short-term debt, 20% in bonds, and 70% in equity. So if you add these three things together here, that's our $19,522. We do have to determine what the costs of interest are going to be on this newly acquired debt that we're getting. So again, you incorporate how you come up with interest is up to you. You could use, as it says here, you could find current bonds and look up their yield to maturity. Then maybe just adjust downward for some short-term debt, right? But in the end, this is the interest that we're going to have to pay next year when we borrow this extra, whatever that is, for $5,800. So when we look at the first, our first peek, if you will, at the forecasting, we see here that the big change here on the income statement is really just interest expense. That interest expense is going to increase by $342 because we're borrowing some more money. Okay, so again, we go down through here, we see how that impacts the retained earnings statement. Quite frankly, other than the change in interest, we're not really interested in this particular slide, with the exception right here, this very last column, as we'll see in a second. This represents the forecasted financial statement at the end of year one. So this is the most recent income statement, and this is our predicted income statement. When we look at the balance sheet, again, you see that we have incorporated now the additional financing. It goes through, and in the end, if you look towards the end here, we have what, 129 and 168. We're off $2. That's no real big deal, right? So here we look, and now this is the forecast of next year's balance sheet. Again, this is this year's balance sheet. This is next year's balance sheet. We can also then see how that money was ultimately distributed. And again, you can see at the end, we have $2 that we didn't account for. Again, in this case, that's not all that relevant. But you can see that very quickly, actually, it gets dispersed and credited throughout the system, so that in the end, we understand that we need to gather $20,000, and this is how we're going to do it, and this is what it's going to cost us. So there is an extension of this tool. If you have a series of historical financial statements, you can use the financial statement analysis worksheet that I've provided to create a long-range forecasting of company performance. This allows you to really see how strategic plans impact the firm. In addition, it allows you to make slower changes. So if you have a number that's really bad and you want to see what happens if you can improve that, again, you may not want to go from really bad to perfect in 1 year. You may want to show how that changes over time and the impact it has on the company. So this continual forecasting, right? The last column of the financials is next year's financial statement, right? This becomes the starting financial statement for the next year. And then you just change the data entry at the top of the page. Again, the output, ultimately we may be able to find several years worth of forecasting. So in our spreadsheet here, if you have historical data, you have 5 years of that, then you'll have 5 years or 1 year to 10 years of projected financial statements. So you'd end up with 15 years of statements. That then also would provide you with 15 years of ratios, so you can see how these projected changes will ultimately impact the financial status of the company over time. So that is pro forma analysis.